Hi guys, Michael here, and in today's video we will talk about the most common mistakes that beginners should avoid while starting their journey with the trading. So, making mistakes is part of the learning process when it comes to trading or investing. Investors are typically involved in long-term holdings and will trade in stocks, exchange-traded funds, and other securities. Traders generally buy and sell CFDs, hold those positions for shorter periods, and are involved in greater number of transactions. While traders and investors use two different types of trading transactions, they often are guilty of making the same types of mistakes. Some mistakes are more harmful to investor and others cause more harm to the trader, and I guess both could gain if they would avoid them. So let's start the countdown with number 1, which is not having a trading plan. Experienced traders get into a trade with a well-defined plan. They know their exact entry and exit points, the amount of capital to invest in the trade, and the maximum loss they are willing to take. Beginner traders may not have a trading plan in place before they commence trading. Even if they have a plan, they may be more prone to stray from the defined plan that would seasoned traders. Novice traders may reverse course altogether. For example, going short after initially buying securities because the share price is declining, only to end up getting shredded. Next is chasing after performance. So many investors or traders will select asset classes, strategies, and funds based on a current strong performance. So the feeling of, the fear of missing out, the FOMO, has probably led to more bad investment decisions than any other single factor. If a particular asset class or strategy has done extremely well for 4 or 5 years even, we know one thing for sure, and it is that we should have invested 4 or 5 years ago. Now the particular cycle that led to this great performance may be nearing its end. The smart money is moving out, and the dumb money, meaning the inexperienced traders and investors, are pouring in. Another common problem is ignoring risk aversion. Do not lose sight of your risk tolerance or your capacity to take on risk. Some traders can't bear volatility and the ups and downs associated with the FX market. Other investors may need secure, regular interest income. These low-risk tolerance investors would be better off investing in the blue-chip stocks of established firms and should stay away from more volatile growth and startup companies' shares. Remember that any investment return comes with a risk. The lowest risk investment available is US Treasury bonds, bills, and notes. From there, various types of investment moves up in the risk ladder and will also offer larger returns to compensate for the higher risk undertaken. If an investment offers very attractive returns, also look at the risk profile and see how much money you could lose if things go wrong. So, never invest more than you can afford to lose. Next is the thing repeated over and over by everyone, including myself, and that is not using stop-loss orders. A big sign that you don't have a trading plan is not using a stop-loss. Stop orders comes in several varieties and can limit losses due to opposite movement on the market as a whole. These orders will execute automatically once a certain price level is met. Tight stop losses generally mean that the losses are kept before they become sizable. However, there is a risk that a stop order on position may be implemented at a level different to those specified. It occurs when the security suddenly gaps, as happens to many traders during the flash crash. Even with that thought in mind, the benefits of stop orders far outweigh the risk of stopping out at an unplanned price. In this matter, a common thing to this trading mistake is when a trader cancels a stop order on a losing trade just before it can be triggered because they believe that the price trend will reverse, letting losses grow. One of the defining characteristics of successful investor and trader is their ability to take a small loss quickly if a trade is not working out and move to the next trading idea. So, unsuccessful traders, on the other hand, can become paralyzed if a trade goes against them. Rather than taking a quick action to cap a loss, they may hold on to a losing position in the hope that the trade will eventually work out. A losing trade can tie up trading capital for a long time and may result in exponential losses and depletion of capital. So, next big mistake, which is very popular, is averaging down or up. Averaging down on a long position in a blue chip stock may work for an investor who has a long investment horizon, but it may be devastating for a trader who is trading volatile and riskier securities. Some of the biggest trading losses in history have occurred because a trader kept adding to a losing position, trying to use kind of martingale trading strategy, and was eventually forced to cut the entire position when the magnitude of the loss became unbearable. So traders also go short more often than conservative investors and tend toward averaging up because the security is advancing rather than declining. So this is an equally risk move that is another common mistake by a novice trader. The importance of accepting losses. Far too often traders fail to accept the simple fact that they are human and they are prone to making mistakes just as the greatest investors do. Whether you made a stock purchase in haste or one of your longtime big earners had suddenly taken a turn for the worse, the best thing you can do is to just accept it. The worst thing you can do is let your pride take priority over your pocketbook and hold on to a losing investment. Or worse yet, open another trade in the same direction. So, going further, next one is using huge leverage. We all know that leverage is a double-edged sword because it can boost returns for profitable trades and can exacerbate losses on losing trades. Beginner traders may get dazzled by the degree of leverage they possess, especially in FX trading, but may soon discover that excessive leverage can destroy trading capital in a flash. If a leverage ratio of 1000 to 1 is employed, which is not that uncommon in retail forex trading, you can simply imagine how small price movement is enough to wipe out the whole account. So often forex brokers disclose to traders that more than 3/4 of traders lose money because of the complexity of the market and the downside of leverage. Another one is trading multiple assets. So beginning traders may tend to jump from market to market, that is from currency pair to another commodity and so on. So trading multiple markets and assets can be a huge distraction and may prevent the novice trader from gaining the experience necessary to excel in one market. First, you need to study one asset at a time. You need to know the drivers for this market and how it moves, and then add another. Next one is the danger of overconfidence. We all know that the trading is a very demanding occupation, but the beginner's luck experienced by some novice traders may let them believe that trading is the easy road to quick riches. Such overconfidence is dangerous as it breeds conceit and encourages excessive risk-taking that may culminate in a trading disaster. So overall, what I want you to remember from this material is to not get too emotional over your trades. Never lose composure. Always keep the trading journal. When you go back to your own posts, you'll notice that even if you're still losing money, for example, there's a great lesson that you've learned over time and much of experience gained. So you need to know that this is a very competitive industry, and so for example, let's compare it to something like maybe a sports analogy would be a good one. So let's say how you can beat Usain Bolt in a 100-meter race when you didn't make any preparations before that. So think about that before you start blaming the market or some EA that just lost your money. Well, lastly, I could add is to calculate risk-reward ratio, because even when the win ratio is very high, with poor risk-reward ratio, a couple bad trades can delete all the profits. So I think that would be all for now. So thank you guys for watching, and subscribe if you liked the video, and till next time.